Hello and welcome to Deal Makers. Now this is a special edition on private equity deals. Yes, this genre of transactions has been the most active one in the last year, clocking in almost $11 billion, and it shows promise of being upbeat this year too. Joining me in this discussion are Sanjay Nair of KKR, Pavninder Singh of Bain Capital, two leading private equity firms, and PE leader at PwC, Sanjeev Krishan, who has been in the thick of action in most of the private equity transactions. Gentlemen, so good to have you on the show today. Now, Sanjay, starting with you. Last year was better than expected. How is the private equity landscape looking for this particular year, and what is it that the investors like yourself are watching for this year?
When the GDP turns, you will need a lot of capital, and I think in that scenario there aren't too many options where you're going to get capital from. I think private capital can be extremely interesting. Both private debt and private equity will be extremely valuable. And I think the other factors really are going to be, how realistic are the valuations and the general view on the macro for India. Even if the valuations become very attractive, but the macroeconomic environment is very hazy, I think private capital is going to be quite constrained.
Let me go to another private equity firm. Pawan, coming to you. What is the strategy at Bain Capital this year? Poised for growth or wait and watch?
No, I think we are quite actively looking for new investments. From an exit perspective, our portfolio in India is still relatively young. Weighted average, it's less than 2 years, and our oldest investment is less than 4 years old. And so I think while we're always looking for interesting exit opportunities, I would say the focus right now is really to look for new investments and then spend a lot of our time actually working with our portfolio companies to enhance value there and help them grow faster, which is a big part of where the team here spends its time.
Right, Pawan, if you are looking to invest more, which are those choice sectors which are looking attractive?
The one theme which clearly I think is important with investors today is looking at sectors that have a natural currency hedge, whether that be healthcare or IT or BPO businesses or other businesses that have significant export component, where if you do see rupee depreciation, while that impacts your investment in some sense, it benefits the business in terms of their growth and profitability.
Of course, export-based sectors have clearly been the darling of the private equity investors. Now, Sanjay, KKR too has built a dollarized portfolio last year. Is that the only theme which is ruling the private equity mindset for this year too?
That frankly cannot be the only long-term strategy. So it just happens to be the case for this year. That's really the only thing one can do at this point in time. I think the other thing one needs to do is, in the local sectors, be very focused on the sectors that have tremendous opportunity for growth. So hopefully the growth can, outperform the exchange devaluation. And that's really the consumption sectors again: healthcare, pharma, IT.
All right, let me bring in Sanjeev also into the discussion. Sanjeev, I'm sure that you have also noticed it, that the concentration of private equity funds is in the safe sectors like IT, pharma. But what about the cash-hungry sectors like infrastructure, power, manufacturing? Is there any change in this trend, or rupee will play the biggest factor this year too?
I think in the near term, they will continue to be the focus of the private equity investors. The private equity investors have actually not focused on any sector which has significant common interface over the last year or so because of the policy paralysis in those sectors, and also the fact that there is so much uncertainty about what the government might do on those sectors. I mean, you look at power, you look at the road where environmental clearances have been a problem, etc. So I think the equity investors have sort of stayed away from those sectors, and that's why they're focused on consumer sectors or any defensive sector really. Having said that, I think there are some green shoots which are now visible, and I would think that the investment cycle ought to turn sooner than later. And as and when it turns, there is going to be focus on the capital goods sector and eventually the infrastructure sector. Already we are seeing some focus on the industrial side and the cap goods side, and eventually I believe they will translate into the infra side as well. But currently there's a lot of pain, and that itself presents an opportunity for private equity investors to take a contrarian bet on the infrastructure side.
Sanjeev, let's see if the private equity firms really have the same view. Now, Sanjay, can this trend change, and what can bring about that change?
My view is that in the next few years, the supply side dynamics have to change for the country. There has to be initiation of growth, creation of real assets. So I would hope, and I think we should be getting more focused on companies that want to create more real assets. We have one cement company, for example, where they have done a few M&As, looking at a few more greenfield projects. I think we would love to see more companies where they take primary capital for growth of real assets, for growth of capacity. So I think the whole supply side dynamic in the country has to change, and I think private equity can be a very valuable pool of capital for that.
Sanjay, very recently RBI has taken many steps to bring down the number of stressed assets also in the system. Can private equity funds be channelized in that direction as well?
Yeah, I think so. I think private capital can play a very significant role. And let's just call it private capital. There are many forms of private capital that can come in from overseas and locally. But the most important thing in that, to attract that form of capital, is to make it easy to get your arms around the assets, to get the ownership change done, and for the banks to be able to move the assets off the balance sheet. Now, I think obviously you've seen some recent RBI pronouncements, which I think are very positive and in the right direction, which in a way motivates the banks to do early recognition of the stressed assets, to take the hits where they have to. And I think that is a good beginning to make sure that private capital can come in. There are a lot of other things that need to be done to make it practical. This is a good start, but there are a lot of things to be done as it pertains to, as I said, ownership of assets or change of management. I think if you get a lot of that done, private capital can be extremely useful to help banks move the stress assets off the balance sheet, move them into private hands, and with or without the same promoters, really try to put these assets back on track, or have a much more organized process of sell down of these assets, which I think will help you realize a lot more value if you were to not do it in a distressed way.
Now, in the year 2013, regulators have been extremely active in giving more voice to the minority shareholders. We have seen in buybacks, mergers, etc. But along with it also came more rules to comfort the retail investors, like the safety net, which we saw in Just Dial IPO, also the interventions on the valuations asked from the companies when going for public offering. Has this made exits tough for the private equity players? Let's find out from our panelists. Pawan, how difficult has been the IPO market for exits?
Clearly investor interest is an issue, but the whole regulatory process around IPO is an issue as well. And that has pushed companies and private equity players into exploring secondaries. And I think that's a theme that's going to be much more prevalent in this market. There's a lot of capital that got deployed in 06, 07, 08 that needs to find an exit over the next few years. Hopefully the IPO markets will come back, and that'll enable some of those companies to exit through that route. But I think a lot of them will find exits in the secondary market, and so that'll be a bigger part of where deployment happens going forward.
All right, you're talking about secondary as a theme developing. Now, Sanjay, coming to you, is KKR really looking for exits, and are there enough options for you?
It's not absolutely top of our mind right now as we enter the fourth year. But yes, we will definitely be on the lookout, because planning any exit also takes about a couple of years. In terms of avenues, public markets are very shallow. I don't think they're going to change overnight. Private capital is there. So I think, between a combination of secondary takeouts and some of the strategic interest in India, which continues unabated, I think there will be a lot of opportunities, good opportunities to work around. But, my worry is there's going to be a lot of exits.
And Sanjeev, you have been an advisor to many transactions in the year gone by. How do you analyze the returns and exits landscape?
There have been some, very nice transactions for investors like Sequoia. They've had pretty good exits on a couple of their investees. Earlier in the year, of course, TPG had a very successful exit as well. So there have been some nice exits during the year. However, I think it would possibly be improper to just say that just count the exits which have actually happened. There's so much money which has not been returned. I mean, by last estimate, some $90 billion which has been invested, and only about $20 billion returned. So obviously the $70 billion which has not yet been returned, that is either not in the money or is going to take time. So when you look at exits, you have to look at the aggregate investment which has happened in the sector, and unfortunately there's a lot of pain out there. So on an aggregate basis, I won't say that exits have been easy at all. In fact, on the contrary, they've been pretty hard, and I would believe that from the vintage of 2006, 7 and 8, whatever can be divested would be divested over the next 18 months or so. The others, possibly people have to take losses on their books.
Yes, tough times ahead, Sanjeev, and we have also seen some companies trying for IPO, but then finally settling for secondary sales. Don't they give less bargaining power, and can they be considered more desperate sales then?
See, there's no doubting the fact that strategic sale is possibly the best option. But, one has to also consider the fact that in India, most of the deals are growth deals. They're not majority stakes in which strategic investors have a greater interest for most part. One. Two is that if we look at the IPO markets were one in India. They were dead last year, but they can also be imperfect. So in that sense, I think the secondary sales is a very important mechanism of exit for private equity investors in India, and I think they will remain so. And also from an incoming investor's perspective, they're happy to sort of deal with someone who is actually proven, a sponsor who has been proven. They may not get the same quantum of 2x, 3x returns that the first equity investor got, but at least they know that the sponsor is credible.
Of course, exit options are few, and where you have the opportunity, probably rupee fall has played a spoiler there in the returns as well. Now, Pawan, you would agree with this?
It's been a big issue. I mean, if you invested back in 07 when the rupee was at 40 and you're looking at an exit at 60, that depreciation alone has taken a big part of your return out on a dollar basis. And most, even India-only funds have dollar GPs. And I think that's been a big issue. I mean, it's also been an issue in the timing of exits, right? People are sitting on INR returns that are attractive, but when translated to dollar returns are not that attractive. And so trying to figure out whether it's through holding for longer to get more growth, whether it's waiting for a better multiple, that I think have slowed exits as well, and has been, from an LP perspective, clearly a big dampener on what returns they've realized from Indian private equity.
Let's look at some of the new modes of exits then, Pawan. Is relaxed norms on international listings giving any comfort? And are private equities really looking at an exit route through that mode as well?
Sure, it does. I think it's a step in the right direction. It helps certain sectors more than others. So clearly things like mid-cap IT, which I think on the Indian market have not traded as well, but have gotten a more favorable response in international markets. I think for them it's a pretty interesting opportunity. In terms of exit, there's still some restrictions that I think the government needs to work through. So I think non-residents currently aren't allowed to sell into an OFS for such a listing. I think that is under consideration for change. The law is also, I believe, at least right now, mandate only for 2 years. And so making that more permanent, where investors can underwrite such exits as part of their investment thesis, I think will both encourage new investments and hopefully allow people to take this path for exit as well.
Let me get a KKR view on this as well. Now, Sanjay, you have done many structured deals, more like debt financing. Can this be called a strategy to make safe investments when exits are looking very difficult?
No, not really. I don't think there is a specific strategy to do more structured over pure private equity, not at all. The way we look at this is that we approach the entrepreneur, the promoter, and the situation. The core business is private equity. And, if things work out in terms of the business strategy, the valuations, and it makes sense to do an equity deal, I think that's what we usually try and do. But many a time, the valuations don't match, the expectations from each other are actually quite different, and frankly, the company needs a different form of capital structure, not necessarily equity. And that's where our structured business becomes very, very handy. So that's really the approach. It's really an approach where you try to monetize the relationship and the dialogue with the company in such a way that you can provide the appropriate form of capital.
Twin deficit issue, low growth, unstable rupee, all make the deal street quite gloomy, and we have dealt with all of this last year. But looking at the spurt in the private equity transactions in the last few months of 2013, are these concerns really behind us? Let's find out from our panelists. Pawan, with rupee stabilizing a little now, do you think that the currency risk is behind us?
I don't share that view. I think the one area where I think investors probably underestimated the long-term trend is in the currency. And flows drove a period of appreciation and stability. But I think if you go back and look over a 10, 15, 20-year period, the rupee is a depreciating, albeit at a slow pace, but 1 to 3% depreciating currency. While the economy still is current account deficit, has a current account deficit, has a fiscal deficit issue, is a high interest rate economy, I think it is difficult to come to the conclusion that the rupee is going to be a stable or appreciating currency.
Sanjay, which are those economic factors and other drivers which will be the deciding factor for KKR in 2014?
Look, I think currently the most important thing for us that we are looking at is just the growth. Usually, we look at obviously bottom line growth, but right now, the way the macroeconomic headwinds are, even the top lines are actually being quite challenged across all sectors. So, when you look at an investment today, we really want to be able to be absolutely sure that there is that promise of growth and the business is equipped to capitalize on the growth opportunity. So number one is growth. I think secondly, a lot of companies today are facing massive inflationary pressures on the cost lines. So one has to really dig deep to verify that the bottom line growth will be as real as given to us by the companies. And there are many other macro things we can talk about, but I think the bigger one then is finally, what kind of dollar returns can we finally get out of the investment? Given that the dollar rupee has been so volatile, it becomes very critical to also take into consideration what our view on the exchange is.
Sanjay, these are all macros. How big a role does a promoter play in this as well?
I think I've said it on the show many times before. I think for us, the most important thing right now is to look at the promoter. Now, quality of promoter is obviously a pretty broad-based word. I think if we know the promoters and the entrepreneurs from our past history, that's the best thing. The most important thing is to make sure you can trust the promoter, number one. Number two, the promoters can trust the private equity partner, and there is a kind of a gelling of expectations from each other from day one, because you can create all kinds of documentation around this partnership. You're never going to get back to the document. You really have to have genuine set of expectations that match and a genuine trust in each other. I think that is of paramount importance, and especially when you have a macroeconomic situation that is quite tricky. You want to make sure that at least at your company level, things are working along, and you're not adding another factor of risk to your sleepless nights.
So since promoters play an important role and are sometimes the most important deciding factor in making investments, Pawan, has your experience at Lilliput and Himadri made you more cautious now?
I think we therefore will learn from our history and experience in India, but I think we continue to be quite optimistic and quite active in terms of looking at new investments.
And what about your investments in Hero Moto? Auto sector is clearly not the flavor of the season.
As we look at Hero, it is a company that has built a terrific competitive position and brand in the country. Their products continue to be market leaders in the segments they're in. While the competition in that sector has increased, they've done well in terms of holding share. We're working with them to really invest in their R&D capability to make sure that they continue to launch new and successful models that'll build on their brand and their share in the country, helping them expand to new export markets, which is something that they can now do, as well as continue to focus on their profitability and make sure that within that market context they have industry-leading margins. And so we're very happy with our investment at Hero. I think we have a great relationship with the management and the family there, and are excited for what it holds in the future.
Sanjeev, most of the times you're caught in the middle of transacting companies, private equity funds. How difficult are deal closures at this time?
So I think three factors. The first factor really is, all the regulatory issues that have come up over the last 2 to 3 years. Equity investors do fret over what that means to their returns, etc. all the time, whether it is a tax issues and others. So I think that's something that is a huge focus, and that invariably takes time because you're negotiating with the counterparty. I think the second issue really has been in terms of getting a deal done, and there you're doing much more work than you were doing in 2006, 7 and 8. I think there's a lot of diligence which is done on the promoter, on the background checks. The diligence itself has actually got extended. You need to be 100% sure about the company, considering again all the governance issues that we have experienced, and the bad experiences, if I may say so, that the private equity investors have happened. So they really are spending much more time getting comfortable with an asset. And finally, I think even the investment committees and others are asking much more harder questions than they have in the past. So typically a deal is taking, I would say, almost double the time than it used to take in 2006, 7 and 8 for these three factors. But I'm very positive about it. I mean, this is the way it should have always been the case. And I think what we have now is the more optimal approach to investing.
All right, point taken. And Pawan, I will let you have the last word. Do you agree that things will look better in the second half of 2014?
I think I would say we are cautiously optimistic. If you had asked me that question 6-7 months ago, the first half of this year I think activity was quite slow, and so the outlook was probably not as bright. I think the last 6 months have actually been better than expected. You've seen a number of large deals. You mentioned some that have closed, and different players have been able to deploy reasonably sized capital. I think rolling that forward, obviously there are some uncertainties over the next year, election being a big one. But we remain cautiously optimistic that I think this will be a good and interesting vintage to be investors in India. And I think if you can find the right opportunities and the right partners, hopefully it'll make for great investments.
So the verdict is out. This year we do see a flurry of private equity deals, and given that the street is more optimistic about the second half of 2014, it has the potential to surpass the deals sealed in the previous year. And gentlemen, I will hold you all to this. Thanks for your insights, and thanks to our viewers for joining us.